All right, welcome to Talk Tickers. Today, we're diving deep into Wells Fargo's fourth quarter earnings for 2025. Now, this one was a wild ride. The stock was absolutely flying high, and then, bam, it took a dive right after the announcement. We're going to figure out exactly why, so let's get right into it.
So first things first, let's just set the stage here because this is the central mystery of the quarter. Coming into this earnings report, the stock was on an absolute tear, up 19% in just 3 months. But then, as soon as the numbers and the guidance came out, sellers just came out of the woodwork, pushing the stock down almost 5%. So the big question is, what happened? Why the whiplash? What on earth spooked the market here?
To get to the bottom of that, we have to start where everyone else did, with the headline numbers. And what you'll see is that it was a really mixed bag, where the bad news, well, it just seemed to shout a lot louder than the good news.
So on a standard accounting, or GAAP basis, earnings per share landed at $1.62. That missed the Wall Street consensus of $1.67. You know, a headline miss like that is never, ever a good first impression.
But okay, here's where things get a little more complicated. If you look at it on a non-GAAP basis, basically after you make a few adjustments, the earnings per share was actually $1.76, and that beat the consensus of $1.69. So what gives? How can it be both a miss and a beat?
Well, here's the key. The whole difference boils down to this one massive $612 million pre-tax severance charge. Think of it as a one-time cost. Once you pull that 14-cent item out of the equation, you can see the underlying earnings were actually pretty solid and they did beat expectations.
But the top line, total revenue, that was a much simpler story. And honestly, not a very good one. It came in at $21.29 billion, which missed what analysts were hoping for by a pretty wide margin. And for Wall Street, a revenue miss is a huge red flag. It just suggests the core engine of the business isn't growing as fast as people thought.
And digging in a little deeper, we see that net interest income, that's the bread and butter for a bank, right? The profit it makes between loan interest and what it pays on deposits, that also came in a little light. It was only a slight miss, but in this kind of environment, you better believe investors are watching that specific number like a hawk. So yeah, the headline numbers, they paint a picture of a pretty messy quarter.
But here's the thing. Management's message on the call was basically, hey, look past this one messy quarter. Their whole narrative was simple but really powerful. The long, painful cleanup era is finally done, and the real growth story is just getting fired up.
The CEO, Charlie Scharf, he couldn't have been clearer. He said getting that asset cap removed by the Fed was a pivotal moment. And it's true. I mean, this was a massive restriction that's been holding back the bank's growth for years. Now that it's gone, management feels like they can finally get in the ring and compete on a level playing field again.
And you can see this newfound confidence in their profitability targets. They're focused on something called return on tangible common equity, or ROTCE. It's really just a key way to measure how efficiently a bank is making money. They started with a goal of 10%, then they blew past 15, and now they're targeting a super ambitious 17 to 18%. That's a big statement.
And they didn't just talk the talk, they brought the data to back it up. I mean, look at these proof points. What's really impressive here is how widespread the momentum is. New credit card accounts are up 20%. Auto lending is up 19%. You've got strong growth in commercial loans, and they're even making real headway in investment banking, climbing up the M&A rankings. This is the heart of the bull case, right here. The growth is real, and it's happening right now.
Okay, so if the long-term story sounds so good, then why in the world did the stock sell off? Let's switch gears and talk about the headwinds, because the market was clearly fixated on the short-term problems, not the long-term promises.
The number one issue? It was all about the guidance. Management said they expect about $50 billion in net interest income for 2026. Now, that is still a staggering amount of money, but it was just a little bit shy of what analysts had penciled in. And that tiny gap signaled that maybe, just maybe, near-term profits might be a little weaker than everyone was hoping for.
But that wasn't the only thing. During the question-answer part of the call, a totally new and unexpected risk popped up, and it really got the market's attention.
So in the Q&A, an analyst asked about a proposal for a federal cap on credit card interest rates at 10%. And wow, this is a huge deal. Why? Because that high-growth consumer credit card business is a major pillar of their entire growth plan. Now, it's just a proposal for now, but it casts this giant shadow of uncertainty over a key profit engine. And if there's one thing the market absolutely hates, it is uncertainty.
Okay, so let's put all the pieces together and give you our take for the next quarter. What you have here is a classic Wall Street tug-of-war,
A really compelling long-term turnaround story on one side, and some very real, very tangible short-term headwinds on the other.
So looking ahead to their next report, here are the 4 things we are laser focused on. First, can they actually hit or maybe even beat that $50 billion NII number? Second, how is their credit quality holding up? We're especially watching commercial real estate and consumer loans. Third, they're sitting on a pile of extra capital, so how aggressive are they going to be with stock buybacks? And finally, any news, good or bad, on that credit card APR cap proposal is going to be absolutely critical.
So, where does all this leave us? Here at Togdiggers, we're kicking off our coverage with a market perform rating. Look, the post-asset cap growth story puts a pretty solid floor under the stock price. But at the same time, that weaker NII guidance and this new regulatory cloud are probably going to keep a lid on things for now.
So if we think the stock is going to be stuck in a range, what's a potential way to play it? Well, one strategy traders might consider is something called selling covered calls against a long stock position. The basic idea is you get to collect some extra income from selling those call options while you wait for these near-term clouds to pass. It could be a pretty interesting way to handle a stock that has a great story for the long haul, but a bit of a blurry picture right now.
And as always, this is not financial advice.